Good afternoon. Welcome to the latest E3 Consulting Property Tax webinar. Today's topic really is focusing very much around the super-deduction with a few tweaks and updates around the budget, other budget announcements from this year, both the March spring budget and the more recent autumn statement. And we'll sort of cover those off and talk through some various case studies. As I say, please do feel free to send in any questions you might have through the question and answer Q&A function, we'll address those as best we can. So without further ado, for those that don't know me, I am Alan Oliver. I'm the Managing Director of E3 Consulting. Very nearly 30 years experience as a property tax specialist and also a CEDA accredited mediator. I spent quite a while working for a variety of different businesses on capital allowances, and then set up E3 Consulting 18 years ago. And we work throughout the UK on a wide range of property tax matters, from capital allowances, land remediation, SIL, repairs and maintenance, and also some VAT advice. Just very quick sort of housekeeping. The intention is that we will run through with the presentations, which will be around 45-50 minutes, and then the Q&A at the end of the session. So please do hang on for that, particularly if you've asked a question, because we will do our best to respond to those. Subject to timing, we may need to sort of deal with some after the event so we can follow up. But do sort of send your details through. Our contact details, telephone and website are on every page, but on the last slide you also have our mobile telephone numbers and our email addresses should you wish to send something through which perhaps you don't want to share. Lastly, we will also be sending out a feedback form after the event. It's really helpful for people to fill in the feedback form. It helps us sort of gauge that we're pitching the presentation so on at the correct level, and giving the right sort of knowledge and sort of knowledge transfer to both our clients and our sort of other guests attending today. So it would be very much appreciated if you could fill that in. As an extra added incentive, there is also a Hotel Chocolat gift, which will be drawn at random from all of the feedback forms that we get submitted back to us. So if you're a bit of a chocoholic, then there's absolutely no excuse not to respond accordingly. Okay, so the programme of events today, apart from sort of setting the scene, as I say, mainly dealing with capital allowances, going through the mainstream allowances, what was set out in the budget, particularly the super-deduction, the special rate allowance and the free ports. We're showing how those impact on the tax savings available in various different scenarios. And then we're just sort of picking up on the complexity of property tax these days with what we're sort of naming as the kaleidoscope of different allowances available. There's so many different variations that it can be quite sort of time consuming and difficult. And then we'll be concluding and running into questions and answers. So hopefully that's what everyone's expecting. I haven't seen a massive dropout of people sort of suddenly deciding to be elsewhere. So that's always a good sign, and we'll proceed. What I wanted to do just very briefly before we get into the meat of today's topic was mention two of those other service lines I mentioned very briefly, one of which is Community Infrastructure Levy. This is just a recent case study on a project we worked on. Just flagging these really because, whilst a lot of people recognise us for our capital allowances services, we do quite often get feedback where people are a bit surprised at some of the other areas that we deal with. So just wanted to make sure that people are aware of that. But this was a community infrastructure levy. This is a tax on new planning permissions, quite complex area of tax, very poorly understood by a lot of the marketplace, both advisors as well as homeowners or developers that end up paying the tax. And this case was a private homeowner in Surrey that had a £22,000 SIL liability on a change of use for an outbuilding. The local authority refused to accept our review. We did a Regulation 113 review under the SIL regulations. The local authority get to mark their own homework, and in that situation they basically sort of said, no, we don't agree, we think it's still liable. The next option is what's known as a 114 appeal to the valuation office. We did that. We basically appealed on 3 grounds, and the valuation office agreed with 2 of the 3 grounds and came down on our side. The 3rd ground, they said they couldn't opine on because it was outside their scope, but it didn't diminish from the other 2. So we saved our client £22,000. Land remediation tax relief is another sort of service line. It deals with sort of long-term derelict sites or highly contaminated sites where you're not the polluter. Only available against corporation tax, so you have to be a corporate taxpayer in order to benefit from this. And again, this was a fairly recent project we've worked on, about 2.8 million expenditure on enabling works for a large housing development. It was being retained and the units being sort of sold off on leaseholds, and therefore they get a 150% uplift. So the original expenditure we've identified was about 580. That gets grossed up to 150, giving them this 880,000, which resulted in tax savings for the client of nearly £170,000. So as I say, just 2 very quick snippets of other things. We'll now sort of move on to capital allowances, and I'm delighted to hand over to my colleague Todd, who will take you through the first session.
I'm Todd Arneson, as Alan has just introduced. I've been with E3 now since 2017, property tax surveyor, working, as Alan said, across our service lines, mainly on capital allowances. And in my final year of my RICS APC at the moment, as a degree apprentice on the Chartered Surveyor Apprenticeship. Since being with E3, worked on a wide range of projects, from some smaller projects of £150,000 refurbishments of doctors' surgeries, all the way up to £140 million mixed-use schemes, and across a number of sectors as well. So what I want to do just before I hand back to Alan in roughly 10 minutes time is just run through the crux of capital allowances, and give a bit of a background overview before Alan takes back over. So capital allowances, what are they? They're an offset against taxable profits for UK taxpayers, whether that be income tax or corporation tax. The core capital allowances are available against both income tax and corporation tax, though there is a distinction to be made here a little bit later on, when Alan gets on to some of the other forms of sort of the new forms of allowances, super-deduction, etc. They're for people who hold a relevant interest in the land, so that could be freeholds, long leasehold, short leasehold, etc. Against commercial property, whether construction, purchase, and you must have a qualifying activity to be able to claim them. So capital allowances, they're available really at all stages of the property life cycle. So what we've got here at construction or purchase of a property, all the way through refurbishment of a property. A key one to note here is leasing. Whether you're an incoming tenant fitting out a property, or you're a landlord who is maybe contributing to a tenant as a bit of an inducement to get them into the property, there's capital allowances available there on their sort of fit out costs, and then repairs, sort of dilapidations afterwards, and then finally all the way through to selling the property, and ensuring that you understand what you're doing at sale so that you can preserve the best position for yourself with your capital allowances. What we like to show here on this graph is the sort of indicative ranges for capital allowances, and what we're showing here is a percentage of either the construction cost or the purchase price of the property, and this is just sort of an average range for where we would expect the capital allowances to fall on a number of different property types. What we're going to do is pick out car dealerships here, and for a car dealership we would expect that the capital allowances would fall somewhere on the average project between 12 and 35% of that overall construction or purchase price. Do note here though that we are excluding the new structures and buildings allowances, which will make up a lot of the other costs to claim on. So some of the available allowances at this time, starting at the top here, we've got first year allowances. These are given at a number of different rates currently. Alan will talk to you a little bit later on the 130% and the 50%. I just want to draw your attention here to the 100% first year allowances on electric vehicle charging points. You used to be able to claim these under sort of the enhanced capital allowances, which have now been abolished. As you'll see here, they've been greyed out at the bottom, but these are still available for electric vehicle points at 100% in the first year. You've also got 100% for your sort of research and development allowances. And then the annual investment allowance, which is currently capped at £1 million, that's also 100% in the first year. The sort of middle two here, plant and machinery, integral features, I'll talk a little bit more on in a second, but this is really the bread and butter of capital allowances and what we advise on. 18% rate, 6% rate for integral features, both on a reducing balance basis. And then you've got some of the other lower rates down here as well for long life and short life assets. And then structures and buildings allowances, these came into effect in 2018. And really a lot of the projects that we're working on now, we're seeing structures and buildings allowances being available now that we're sort of, all of the construction projects have been built out at this time. So these at 3%. So a little graph then to show how the sort of core capital allowances work in principle and how those rates work. What we're assuming here is that we have £250,000 of each allowance. This green line being plant and machinery allowances, the purple line integral features. So we've got our 18% rate and our 6% rate, and then the structures and buildings allowance, this new allowance at 3% per annum over 33 1/3 years. And by assuming we have the same amount of allowance here, this graph is just showing how quickly you can claim this sort of higher rate of allowance and how quickly you get that tax relief compared to some of the others. Although what you will see is that they will eventually end up at the same point after a period of time claiming all of that tax relief. There's a little kink here at the bottom in the structures and buildings allowance. This is just where the rate changed from what was 2% when it was initially introduced, 2% over 50 years to that 3% rate that I've talked about. So then, the sort of main capital allowances, the core capital allowances that I've been talking about, plant and machinery, these are sort of our main pool allowances that, as I've noted up here. They're giving it 18% on what's called a writing down allowance. So that's 18% per annum on a reducing balance basis. And plant and machinery allowances are really available in all commercial property, as we say here. A few things that qualify as plant and machinery, you've got your furniture, carpets, and then a couple that are noted in green here, fire alarms, IT and data installations. Now, the reason they're noted in green is because on a construction project, we'd expect to find these under the electrical package. Although these items qualify for plant and machinery allowances at the higher rate of 18%, the general electrical items will only qualify at 6% for integral features, as I'll note on the next slide. So it's important to make that distinction and split out those costs. Plant and machinery allowances and capital allowances in general, generally available on large-scale residential property as well. And that's in the common areas, so your circulation areas, any common areas in the building, plant rooms, etc. Claim the capital allowances there outside of the individual dwelling. So it's an important point to note and something to pick up on for those large-scale residential developments. And what we'd expect to find there in the common areas are things like the fire safety installations, carpets, concierge counters, etc. And then also in furnished holiday lettings as well. This is in the UK and EEA, so the European Economic Area. There's been no changes announced post-Brexit, though we are keeping a close eye on that at the moment to see if anything does change in the near future. And then our 6% integral features that I've already noted, these are sort of sat in the special rate pool. something that Alan will discuss a little bit more later when we come on to the super-deduction. But again, a 6% writing down allowance per annum on a reducing balance basis. And then these are electrical systems, as I've already noted, which includes lighting, cold water systems, sort of your heating, ventilation, and air conditioning. And then we've got lifts and escalators as well. On a typical project, we'd expect the integral features to be somewhere between 30 and 65% of the overall capital allowances that are available on a project, excluding the structures and buildings allowances that have been introduced recently. So the structures and buildings allowance then, this, as I said, available on structures and buildings previously non-qualifying for capital allowances before their introduction in October 2018. And although they're available on what I said earlier would be most of the balance of the construction costs that don't qualify for the sort of plant and machinery and integral features noted earlier, they're not available on landscaping costs that don't create a structure, and they're not also available on planning permission costs either. The contract must have been entered into for the construction works on or after the budget date of the 29th of October 2018 when they were introduced. And they're written down on a straight line basis rather than a reducing balance basis as the other allowances for 3% per annum for 33 1/3 years. And again, here I noted before that they changed from 2% in April 2020. Now, it's not possible to claim on structures and buildings allowances without analysing all of the costs for the construction works, because SBAs aren't available on your general capital allowances on the expenditure that qualifies for plant and machinery allowances, integral features allowances, and other repairs as well. So without analysing all of the costs, we're not able to claim the structures and buildings allowance. And as Alan will come on to shortly, these have been boosted for Freeport areas up to 10% per annum over a 10-year period. There are some restrictions on the structures and buildings allowance. They're not eligible for the accelerated annual investment allowance, so that 100% first year for the first £1 million, they're not available. They're also not available for residential use. That includes purpose-built student accommodation and furnished holiday lettings. And upon sale, at disposal, the purchaser of the property will take over the remaining allowances. But this is subject to the appropriate records and evidence being in place for the purchaser to be eligible to claim these. For most capital allowances, they don't tend to interact with capital gains tax until there's a loss on disposal. However, for the structures and buildings allowance, this has different rules to the other capital allowances, and there is actually a clawback on disposal. Just a quick recap on some of the introductions that were made back in the spring, and then the most recent budget as well, we'll come on to shortly. So back at the spring budget, one of the main areas of change outside of capital allowances generally was the corporation tax increase from the 1st of April 2023. And that's going up to 25% for those with profits over £250,000. Now, on the face of it, that is outside of capital allowances, but as Alan will show you later through some of the case studies that we put together, that will significantly affect the tax relief that is available on the allowances as they are claimed over a period of time. And then, as we note down here, we've got this new introduction of the super-deduction at 130% for the main pool expenditure that I talked about, the plant and machinery allowances, the 50% special rate allowance for the special rate pool, which is the integral features allowances that I've talked about, as well as the long life assets, and then the enhanced rate for capital allowances in the Freeport sites. So finally, then, the recent autumn budget, it was a little bit of a non-event for capital allowances. These 2 points that were raised and announced are more clerical issues than anything else. Annual investment allowance, this was due to revert its cap was due to revert to £200,000 on the 1st of January 2022, so that would be 100% on the first £200,000. However, they've temporarily increased or kept the limit at £1 million, and that's been extended until the 31st of March 2023. And then the structures and buildings allowance. What we've got here is some administrative tidying up, as we've called it, in this line. I did note a couple of slides ago about the records and evidence that are required for claiming the structures and buildings allowance, and that's what's known as the allowance statement. And what we've got here is just some increased measures around the allowance statement for works to properties that had already been brought into use. And this is really about the government trying to sort of tackle any potential tax abuse that might be coming around. So what I'd like to do then is hand back to Alan, and he is going to take you through the super deduction and free ports.
Right, thanks very much for that, Todd. So super deductions sound great and give a high level of tax relief, but they haven't given them with simple rules. And when there's 130% tax relief, you can imagine that the government does put some complications around that. So it is quite a complex area, which we'll drill down into over the next 15-20 minutes or so before we look at some run through some of the cases. So there we go. As Todd said, it was introduced in the spring budget earlier this year. It's a brand new form of allowances, enhancing what was normally the plant and machinery rate from that 18% writing down allowance to 130%. So it's quite a big boost. Unfortunately, the government, in their wisdom, have restricted it only to corporation taxpayers. So there's a lot of businesses, farming or dental practices or surgeries, which often work as partnerships or as individuals, won't be able to do that, won't be able to benefit from these super deductions because they're normally just paying income tax. It's not a panacea for everyone, and therefore things like the annual investment allowances will still be equally important. As you can see here, when they first announced it, it was caught by what are known as the general exclusions on leasing. And so what that's meant was that originally, when they first sort of talked about this, if you're a property landlord holding property for investment purposes, therefore renting it out and leasing it, there was this general exclusion under Section 46 of the Capital Allowances Act that basically said that you can't get sort of enhanced first year allowances. However, in the Finance Act, and after quite a bit of lobbying from government, including ourselves, from industry to the government, including ourselves, the government sort of introduced this exclusion, a lovely bit of government tax take, because it's a double negative, an exclusion from an exclusion. But it now means that landlords are able to benefit from the super deduction on expenditure within the relevant period. What does that mean? Well, the super deduction, it's for contracts entered into on or after the 3rd of March, which I believe was the spring budget date, but it's only on expenditure incurred on or after the 1st of April this year through to the end of March 2023. So it's quite a limited period, but obviously if you've got projects which meet that criteria, then it's absolutely good to have, and will be a real boost. And we'll see some examples of how the numbers look if you're able to benefit from the super deduction. It gets quite complicated if your accounting period doesn't end on the 31st of March, but some other period, and therefore you straddle that end date. So I've got some examples just to sort of show that through, because obviously with them giving you tax relief for over the 100%, again, there's some criteria there. And there are also anti-avoidance measures whereby people can't sort of cancel previous contracts and start a new contract. And those can be quite punitive as well. So this is quite a complex looking slide. So they're basically, this is the formula that they're required to look at. So you look at the number of days before the 1st of April 23, which is when the rules change at the end of March, and the number of days in your period total. So effectively what we've sort of shown here, if someone's got a £10 million project of which there's £4 million of eligible spend, we've assumed roughly £1 million a quarter. So if your year end was a 30 June year end, rather than getting the 130%, the maths of this formula work out that you would get relief at 122%, but only applied to the expenditure prior to the 1st of April. And then the expenditure after the 1st of April would be the normal writing down allowances, claimed whether as AIAs or as the writing down allowance as applicable. So broadly, that would give you a tax saving on these numbers of 1.1 million. And you can see as time goes on and the percentage goes down because you've got more expenditure falling outside of the relevant period, whilst the allowances for the total period hasn't changed, the balance of expenditure with the super-deduction or outside of the super-deduction has changed. So the tax saving overall reduces from the 1.1 to just over the £1 million if you've got a December year end. So something to be mindful of, a bit more maths for everyone to work out in terms of making the claims and processing things, but just important to be mindful of in terms of making sure that people sort of get the right figures and use the right numbers. In addition to the super-deduction, the government also boosted the integral features rate, and they declared that as the special rate allowance. And this is 50% instead of the usual 6%. Special rate allowances is all the integral features, long life assets also sit within there, and also thermal insulation added to an existing building also comes into this category under Section 28 of the Allowances Act. So that's just a standalone bit to encourage people to insulate existing buildings. Again, this tax rate, this boosted rate, is only available to corporation taxpayers. The government get a bit sort of finicky about this and get a bit paranoid that if they make it too easy for everyone to claim, including income tax, then people do get involved in some fairly aggressive tax planning. But that's I think more paranoia than reality these days. There's a lot of reasons why people don't want to get involved in very aggressive tax planning anymore. As before, it was originally excluded because of the leasing, but that's all now sort of changed. So it is available to landlords and investors as well as owner occupiers. So can be very useful. The same timing conditions apply, and there's not as complicated sort of clawback and apportionment required because it's not over the 100%. So it is slightly more simplified, but again, there still will be some apportionment of expenditure, which bridge different sort of accounting periods. And again, there's anti-avoidance measures to stop people playing the system too much. This is a penthouse suite of a very nice London hotel project we worked on a little while ago. Within this project, it had two different sort of parts. That we did a purchase claim on the original purchase, which was a £20 million office purchase. There was a 198 election, but we were still able to do an integral features only claim, and we managed to get that done for the client. That actually preceded the change to the super-deduction, the special rate allowance, so that wasn't part of that. But then they undertook a significant redevelopment of the building, nearly £27 million refurbishment, to turn it into a very modern 5-star bespoke sort of hotel. And that's a fantastic sort of project, and we ended up with nearly 60% of the qualifying cost eligible for tax relief. And again, this sort of predates the structures and building allowances as well. So it's quite significant. So really just sort of showing how that is. So the first column here shows you the breakdown of what expenditure we got on that refurbishment. They were a UK corporate paying income tax, corporation tax at 19%. So you can see here the level of plant and machinery, integral features, the repairs and maintenance. Being an existing building, there was some repointing and so on. At that time, the annual investment allowances was capped at the lower rate of 200,000. And so you can see the first year tax saving was about 700,000. And overall, they're going to get tax savings of about 3,060,000 or so. And that's still sort of carrying on and drip fed through their sort of corporation tax. Now, if we were to look at this project again under the super deduction, say for expenditure next year or something, then you can see it changes very significantly. So a lot of that expenditure goes through into the super deduction. The plant and machinery has come down here. Again, the integral features has come in here, but we are taking some of that as annual investment allowances as well. Repairs stays where it is. And you can see here that massively boosts the first year to about £3 million tax saving, 3.2 million. So it's a very significant boost, and the company can then sort of claim that and roll it forward if that's in excess of their chargeable profits, and continue to sort of claim in the normal way. This one at the end just sort of shows that if it was in 2024, after the tax rate's gone back up to this higher rate of 25%, the super deductions aren't anticipated to be extended, because one of the reasons they brought this in is to stop people from delaying expenditure, recognizing that with the higher tax rate, people might sort of defer from doing things now until the tax rate goes up. And that's really why when you factor in this 130% at the current tax rate, it's equivalent really to 24.7%, so very nearly the 25, and that's really a big part of why it's there. But again, you can see here that the numbers sort of change. The overall tax saving has gone up because of the tax rate, and the first year benefit has gone up also. But without the enhanced first year allowance, it's a bit more sort of drip fed over time. Okay, so this is another project that we've worked on for a client in the Thames Valley. It's a headquarters office project, £2.2 million refurbishment of their office space. Very significant sort of project. And within that, we were able to achieve about a 70% of the costs qualifying for relief. So again, sort of, a big sort of expenditure there. Again, just sort of showing the numbers on that. You can see here that the majority is coming as plant and machinery. About a third, as Todd sort of said earlier, is coming as integral features. We also had some enhanced capital allowances, but as Todd mentioned, they've now been abolished. So when we roll this forward to a notional same project in 2022, some of that money's gone into the plant and some of that money's gone into the integral features to adjust for the non-availability there. Repairs have stayed the same, but we're then getting this super deduction on the plant element. And again, you can see that we've gone from 187,000 first year tax saving to 310,000, and pretty much everything is being claimed in the first year. So you get all of the tax relief in year one rather than this sort of drip fed approach. So again, it just shows that these super deductions can be a very significant boost to businesses that can afford to bring their projects forward and accelerate the works. Okay, we also mentioned in the spring budget, they talked about free ports, and they were also featured in the autumn budget from a couple of weeks ago. So free ports was a new initiative the government's been talking about for a little while. They announced a sort of an appeal or a prospectus in the spring budget, and various different parts of the country applied for that. So initially, they sort of cited these 8 sites of East Midlands, Felixstowe, Harwich, Humber, Liverpool, Plymouth and South Devon, Solent, Teesside and Thames. And then the part of it was that they would get various different sort of benefits to try and accelerate and improve growth and business development. So there's reduced planning requirements. There's accelerated sort of tax relief from capital allowances, which I'll come on to shortly, but also there's some adjustments around sort of national insurance, business rates, and stamp duty on buying or leasing the sites. So there's a real sort of portfolio of different measures, but all around incentivizing growth and economic activity in these centres. In the autumn budget, Humber, Teesside and Thames are the three that got given the go-ahead, and they're sort of set out to start from this month, subject to legislation being passed, which I'd probably sort of come through in the next sort of couple of weeks. And those three designated sites, they have what they call a tax site, and as you can see from here, you've got Humber includes the Able Marine Energy Park and ABP's Immingham's site and Hull East. Then Teesside is made up of Teesside Works, East, West and then Wilton, and Thames is made up from Ford Dagenham, London Gateway and Tilbury. So they all have sort of very specific sites and they're set out. So here's just an example of one of the tax designated sites. This is the Ford Dagenham site. As you can see, they've excluded existing buildings. This is some water sort of balancing ponds, but anything developed within the period and brought into use by the end of September 2026 will basically get these enhanced tax measures. So what are the enhanced tax measures? So as I say, they've sort of, government have currently announced 3 out of the 8 that was first announced. Not sure quite what's happening to the other 5, whether they're still just going through a refining process or not. But I'm sure over the coming weeks we'll see more about that. Government also is keen that devolved governments, Scotland, Wales, Northern Ireland, also introduce free ports. The Scottish government, wanting to be different, have phrased theirs as green ports and largely been a bit critical of free ports, but they've still made some noises about introducing green ports. So there's still something sort of coming forward on those, and I'm sure there'll be further announcements over the course of the next sort of 6 months or so. But from a capital allowances point of view, Todd briefly mentioned before, the structures and building allowances, the normal default rate is this 3% for 33 1/3 years. If the property is located within a free port tax site, then that will be boosted to 10% for over 10 years. So a much quicker accelerated tax break for that part of the expenditure. Main criteria is that it has to be brought into use, as I say, before the end of September 26. I think one of our frustrations with these announcements is really around the time scale that the government's using. Some of these sites will have projects in the pipeline, but others, the time scale around sort of planning permission, maybe raising the funding, maybe then building and then getting it occupied and brought into use, is still fairly tight. You're talking about less than 5 years now to meet that sort of deadline. And for a large capital project, that can still be quite a race to achieve. We then got the normal plant and machinery allowances. So special rates are the special rate allowances and the super-deduction are applicable if it's a corporate. But outside of those and within the expenditure period going up to the September 26, there is also a boosted first year allowance of 100% for only corporation taxpayers. So again, the government's slightly sort of myopic about how it looks at these, but again, there are some valuable incentives for those that are able to invest in these tax sites and free port areas. This slide really just sort of summarizes the position. It's a slide that we've modified very slightly, something that the Treasury put out back in the March budget, where things have changed slightly, but you can again see the purple ones are only sort of corporation tax available, and the green ones are available for both corporation tax or income tax purposes. But again, it's just starting to show you the sort of complexity of the different rates, different types of approach that's required, which is why having someone like ourselves assisting and analysing your expenditure means that you can get the right amount of expenditure in the right pot. Okay, just another quick example of how that works for this is a long-standing client of ours. I think we were first introduced through a sort of project manager, and having done a number of other logistics centres for the project manager for another business. Typically, what we're finding, these are large sheds for a variety of food, sort of logistics fulfillment products coming in and out of the country, and they range typically between sort of £7 million up to about £20 million. And typically, excluding the structures and building allowances, we're getting about 30% of it being qualifying spend. Quite often they're high-tech buildings. If it's food production and food processing lines, then they've probably got sort of refrigeration and other factors that are pushing that up from your normal shed, which might be a much lower sort of 10 to 15%. So just again, looking at some of the numbers, you can see this sort of typical project, 1.4 million of plant. We've claimed most of the integral features under the annual investment allowance, which is this figure here, giving a tax saving in the first year of about 270,000. If we were to look at that in 2024, when the tax rate's gone up, you can see that the tax saving has increased very slightly overall, albeit the first year has gone down, because in 2024 we lose some of the first year allowances that are available, and we're assuming here that the annual investment allowances has reverted to the 200,000 rather than the first million, which is why that first number goes down. However, if this was located in a free port, the same project you can see it's boosting this first year allowance massively to the 740,000, albeit over time the tax saving is pretty much the same. So again, just sort of highlighting how that runs through. So as we've sort of said, it's super complicated because there's a lot of things there, but our branding, as many of you will appreciate, is that we evaluate the situation, we evolve it with our expertise, and hopefully enhance the tax savings and outcome for our clients. As we've sort of badged this, the kaleidoscope, just reinforcing, Todd's gone through a number of these, but there's at least these sort of 13 and probably a number of others when you talk in the different variables for whether it's a free port or not a free port and so on. So it's very much very important now for people to very carefully analyse what they're doing on their capital projects to make sure that they're truly optimizing their claims as they can and getting the best sort of relief and outcome possible. Just finishing off really is this, just sort of again showing the ones which are sort of income tax and corporation taxes, this green shaded area, and then you've got the land remediation, the super-deduction, the special rate allowance, and this is the free port enhanced plant and machinery, which is only available to corporation taxpayers. But again, you've just got this sort of variety of different reliefs that just make it more complicated. Final quick sort of case study. This is a doctor's surgery that we've recently done in the Midlands, 3.1 million. In addition, they had a contribution, Section 106 contribution from the local authority towards the refurbishment and towards the build cost of this brand new surgery. And we ended up with a claim around 35%, excluding the structures and building allowances. Again, we just sort of show how this sort of works. So the numbers here, doctor's surgery, income tax typically, so they can't benefit from the super deductions. So the normal numbers, they're getting 430,000. We're showing it again, just highlighting that super deductions not applicable even if they were in the right period. And then we've shown this as an alternative if it was a corporate investor holding the property, and you can see then that again, with the tax rates changing and going down, although they get the super deduction, the tax savings still are overall less because they're at a much lower sort of tax rate. So again, you can just see the importance of what the tax rate is as to what the overall savings apply. Just really looking to draw this to a close. So these last couple of slides just really sort of emphasize the complexity around things that clients and advisors have to consider around the expenditure. So these are all the sort of questions that you should be thinking about, you know, in terms of whether you've got contributions from third parties, whether it's located in a free port, whether you're, you know, is it expenditure on landscaping, is it on the building, is it on the, you know, the structure and fabric or plant and machinery and so on. Repairs, you know, have to be revenue expenditure and not sort of capital improvements. And then we then sort of look at those. So one of the key things really, and we've been doing this for a number of clients, is helping them just understand all the different options, because, you know, it's not necessarily straightforward which allowances you should be claiming, particularly with things like the SBAs, where there's a clawback, depending on your sort of hold profile of how long you might hold the property and what else you might do with it in the future. So there's a number of different things that people might want to think about and look at. And as I say, we have been helping clients look at those numbers and run it through to try and decide on the optimal sort of tax strategy. So by doing that, and also just considering the risk management aspects in terms of compliance with what the revenue said, as Todd mentioned at the beginning, structures and building allowances are only claimable on the bits that aren't otherwise allowable for other parts of the expenditure. So you know, those of you like me with grey hair might remember the industrial building allowances, and you had a choice with industrial building allowances of claiming it all as an industrial building, or segregating it into the plant and machinery at the time, and the balance being the industrial building. And that option to choose is no longer available to the taxpayer. With the structures and building allowances, you're only able to look at it when you've already abstracted out all the other expenditures which have tax relief against them. So you can't just sort of have a simplistic life of claim it for the others. And we have seen a number of accountants just do that, and clients do that, where they just sort of lump it in. But it is contrary to the rules of how it's supposed to be calculated. So just to sum up, it is very complicated. Yes, it's 130%, but it is limited to corporation taxpayers only. The special rate allowance gives you this 50%, again, restricted to corporation tax. Free ports, they've announced 3 of those sites. We're waiting for legislation for them to come into use, but they should be effective from this month. Excuse me. But all in all, this is just making it more complicated because there's so many different variants of how the capital allowances regime may apply to your projects. The budget did introduce these minor changes. It was long expected that they would extend the £1 million cap on the annual investment allowances, which they did. And again, as Todd sort of mentioned, there's also now the structures and building allowances just tidying up around the record keeping and this statement. So that's pretty much everything. I'm conscious that we've got about 10 minutes left, just slightly over. And so we'll be delighted to sort of take any questions. If I can invite Todd to join us again.
Thanks, Alan. Okay, so we had a couple of people that, or a few questions ahead of today that were asked. So I'll just pose those first while we get some more through on the Q&A function. So one of the questions we had, Alan, was, as a small-scale landlord who owns property both personally and as a developer who trades within a limited company, they're keen to understand the tax implications of the new changes, specifically in relation to refurbishment and upgrading existing housing stock.
Yeah.
And then in addition, they're keen to understand if there are any differences in the allowances, if it's a rental property held as a company or if it's held as a private individual.
Wow. Okay. Well, there's quite a bit there. I'll try and pick it all up, but if I miss anything out, then do nudge me. I mean, the key thing really is the as we've said, the super deduction is only available for corporation taxpayers. So you get the boosted 130% for any expenditure, which is the plant and machinery expenditure, where it's been incurred through the corporate entity rather than held personally. But the counter to that is that held personally, you may be paying tax at 40% or maybe even 45%. And that in itself can accelerate the relief to you. So again, this is where looking at the numbers and looking at the implications is perhaps quite important to decide how you incur that expenditure, whether personally or through the company. In terms of it doesn't make a difference from claiming the allowances as to whether it's through a company or an individual. They both have the right to make the claim. But as we've mentioned, it's the tax rate and whether you get the super deduction is applicable. But without the super deduction, there's still the first year allowance, the annual investment allowance, which is capped at the first million. So, unless you're spending an awful lot, that's probably going to cover most of it as well. So in the short term, it would make some benefit there. In terms of holding stuff as a developer and trading stock, then unfortunately, there's no capital allowances available for that. Although as a developer, they can offset their property cost in building the building as part of their sort of trading operational sort of expenditure. So they do get a tax deduction against that as part of their sort of business activity. It's the same as Heinz Beans making a tin of beans. The building is your stock, not your asset. It's what you make and sell. So from that sort of point, I think I've pretty much covered that. Possibly the only other area might be things like HMOs. Obviously, normal residential property doesn't attract capital allowances, but you can get capital allowances on common areas of large blocks. So if you've got a tower block, we worked on a project recently in Stratford, North London, and that was a 32-story tower. All the common areas, all the lifts were all claimable as part of the expenditure in the common areas, fire alarms, lifts, concierge desk, and so on. Whereas on the smaller end of the scale, we tend not to get involved in too many projects around HMOs, homes of multiple occupation. And there has been some case law on this in the last couple of years, a case called Horatevic versus the HMRC. And that basically says that you can only claim in respect to sort of common areas which are outside the personal use of the individual occupiers. So I think I've pretty much covered most of that, Todd.
No, I think you've got all parts of that question. Thank you, Alan. So another one that came in ahead of time then, they would like to understand whether solar photovoltaic assets are included in the super deduction, and whether we've advised any clients, investors or asset owners on those.
Okay. I mean, we've been involved in a variety of projects where there's been photovoltaic assets involved. I'm not sure whether all of them come into the super deduction because most of those projects predate the change in the rules. As I say, that for the super deduction, it has to be out of the budget date, which was the 3rd of March 2021. And it's for expenditure only between April this year through to March 2023. So I think most of the ones where we've had solar PV involved probably predate that, but we've certainly been involved in a number of projects. Our view is that they are plant and machinery assets, and so they will be eligible for the super deduction at 130%. But obviously you do need to make sure you meet the other criteria around the sort of qualifying activity and owning the assets and so on, and incurring the costs in the relevant period. So I think those are the sort of key important bits there.
Yeah, perfect. And then a question that's come through is, how is a super deduction claimed on a property purchase?
Okay, for a property purchase, if it's so super deduction is only eligible for new expenditure, typically sort of new construction expenditure. But you can still get the super deduction if you're buying an asset from the developer that built it, as long as it's still new and unused, i.e. you're the first purchaser and no one's been using the building for something temporary or otherwise. So if you buy it from the developer, yes, your purchase price, you can then sort of calculate your super deduction at 130% on the relevant plant and machinery aspects, 50% for the special rate allowance on that sort of purchase price. So that would work. Ordinary purchases of existing, for want of a better phrase, second-hand buildings, super deduction is not relevant and not available. But we could probably do an entire day on capital allowances around purchases and the new fixtures rules, because those in themselves are sort of quite complex. I won't really sort of dwell on that now, but I think the key thing to say is if people are sort of buying second-hand property, it's absolutely essential to consider the capital allowances early on, preferably before heads of terms are exchanged, because making sure that the offer is subject to capital allowances or subject to the detail of understanding what may or may not be available is really important, because a purchaser's ability to claim is very much dependent on what the previous owner, the vendor, may or may not have done. And if they don't cooperate, and if you haven't got some contractual obligations set out for that cooperation, it can be very much more difficult to ensure that they benefit from the allowances. Final point really on purchases is, and Todd did briefly mention it, about the structures and building allowances. So structures and building allowances are transferable. So the first owner claims their structures and buildings, say they own it for 10 years, they've got their 30%, 3% over the 10 years. And then the balance transfers to the new owner and continues on the same straight line depreciation for the balance of the remaining 33 and a third years, assuming they don't change the period. So, that's pretty much how that works through.
Perfect. And then probably, I guess, as we're coming up to past, probably just a quick question then as we finish up here. How does the timing affect a claim for the super deduction?
Well, I mean, it's all dependent on the time the expenditures incurred and the contract date. So as we sort of set out, the budget was announced on the 3rd of March when they first introduced it. And so it's for contracts on or after the 3rd of March 21. If you've entered into a contract prior to that date, you cannot sort of stop and cancel that. You've got to proceed with it is and without the super deduction. But if it's a new contract after that date, then that's the start point. The next trigger is when the expenditure is incurred. And so it's very much incurred from the 1st of April this year through to the 31st of March 2023. So again, it's a sort of 2-year period. It's quite limited. There was a slide earlier where we sort of talked about the straddling the accounting period. If your accounting period ends in June or September, we gave a couple of examples of how that works. So it is sort of quite complicated, but and it is still only available for the corporation taxpayers. So yes, it's nice. Yes, it's good to have. Yes, it's important and gives valuable relief. But for other investors and occupiers that may be a partnership or a sole trader, they can still benefit from accelerated relief through the annual investment allowances on their first £1 million. So that's probably just as equally important, really. I think that pretty much takes us up to time. So conscious that we've sort of set out that we would hold you for an hour. We've gone through that. The last slide that you can see now just has our advisory note that we're not advising you, but just sharing some of our ideas. Obviously, from a risk management point of view, we don't want to be sued. If you've got any specific project requirements, then please do get in touch with us. You've got all of our contact details there. We are active on Twitter and LinkedIn, so if you'd like to follow us on those, that would be helpful, and you'll get various updates, largely around property and taxation, occasionally around rugby and something else. and the other sort of property stroke South Coast related activities that we get involved with, and some of the charities we support. But otherwise, I'd like to sort of thank you all for attending. I hope you found it insightful and useful. As I say, we will be sending out a feedback form, which we would very much appreciate you could complete and send that back to us. So thank you very much. I'll sort of sign off and leave Todd to say goodbye as well.
Thank you very much for attending, everyone, and we hope to hear from you soon. Thank you.